This week, we got updated details on SoFi's institutional ownership. This comes a few weeks after the earnings report, so the timing all makes sense. And what we found as we looked through the numbers was that one of the top 10 institutions for SoFi just sold out of their stake entirely, dumping millions of shares in the market. We'll be talking about this and a couple of other SoFi news in this video. Let's dive right in. Okay, so first I'll start off with some housekeeping on the channel. Obviously, you can tell I'm not at my normal setup. I don't have a mic. I'm traveling over the next several weeks, and I'm going to be trying to put as much time into content as possible, but I likely won't be able to make all the shows. We don't have Bootleg Weekly coming up this week. SoFi Weekly is at a different time. It's also affected somewhat my ability to stay on top of SoFi news, but everything should be back to normal within a couple of weeks. If you're new to this series, I recap the SoFi news that I saw over the past week on Fridays, typically on Fridays, but sometimes on Saturdays as well. There was three main pieces of news that I saw this week that I wanted to talk about. But first, let's start with the stock price action. SoFi stock was up 3.7% over the past week, closing off at $7.28. But it's been flip-flopping throughout that price. It was up almost 8% at the beginning of the week and then gave up all of those gains, and it came back down to the 7.15 range. So it's been quite volatile, and I personally don't mind all of that too much. The biggest thing for me is that this thing is range bound and we're trading in the $7 range. It's becoming really tough to break out of that range. So going into the specific news this week, first of all, let's start off with something exciting. We've seen somewhat of a resurgence in meme stocks over the past 1 to 2 weeks, ever since Roaring Kitty made that post. I think that was last week, with GameStop and AMC going parabolic again. I made a post on Tuesday that among these names, SoFi was also trending in the Wall Street Bets community. I shared some further thoughts on this on the Bootleg Weekly on Wednesday, but I'll add some commentary here more in depth. Basically, I don't love the fact that SoFi is associated with these names because they invite a specific type of trader, a short-term trader mentality, and with that comes a lot of volatility. It also brings back to the surface this SPAC association, which we tried so hard to disassociate SoFi from, as the majority of the SPACs were not profitable and were actually bad investments to make. And with SoFi, ultimately, this is now a profitable company. It has amazing growth prospects. And so I don't love the fact that it's also being associated with meme stocks, again, most of which don't have great fundamentals or underlying business models altogether. However, one of the silver linings is that this does put an emphasis on the short interest, and having it trend on a forum like Wall Street Bets could encourage more people to start a position due to this setup having a fundamentally strong business with such a high short interest. Either way, I don't expect anything material to come out of this. I think the main thing here is we really need a sustained breakout out of this range. Seeing as we've broken past this range before, I don't think that's a difficult thing to do. It's the fact that we're always dragged down. And frankly, I don't think the Wall Street Bets community is going to be the one to provide that sustained breakout because of the type of mentality of trader that's associated with it. It's short-term trading. So most of them would probably buy into the stock at $7, and the moment we hit $10, they would take their gains and they would run because they're not in this name for a long-term viewpoint. That's not why they're here. They're here to make a quick buck as they trade up and down these volatile names. And so if we're really thinking about a sustained rally, I personally don't think the Wall Street Bets community is the right type of person you want to attract to encourage that sustained momentum. Now, as I mentioned, there were a couple of key pieces of news for this week. The first, and as we speak about that sustained momentum upwards, is that we got updates this week on institutional holdings through a series of 13F filings released on Wednesday and on Thursday. Now, some of these filings were quite interesting. A caveat here is that this does not really tell a full story. I've mentioned this before, but I'll say it again here. Take this with a grain of salt, because even if we see a firm increasing their position on Fintel, they could be doing so as a hedge against a short position. They could be doing so as a custodian to their underlying clients who are buying that underlying stock. So there's really some different considerations there. We can't just make the conclusion that, oh, JP Morgan is insanely bullish in SoFi because they're increasing their position. There could be a number of reasons why that could happen. And with that, and all the other stuff that you see online, just take it with a grain of salt and do your own research. Now, I made a post last week showing this chart with institutional ownership over time, and we can see a steady accumulation in the institutional ownership. I'll cherry pick a couple of the individual line items here, but there's a lot to choose from. One of the notable ones to me, which I made a post about this week, was Jim Simmons' Renaissance Capital, who increased their position in SoFi. And the reason why this one stood out to me was because Simmons passed away last week, one of the greatest investors of our time. He passed away at the age of 86. If you haven't already and you are interested in learning more about him, read the book called The Man Who Solved the Market by Gregory Zuckerman, which I think provides a really interesting commentary and just biography of his life in general. Really fascinating approach there to investing. But I digress. I'll just put up on the screen here a post from Kyle of some of the notable institutional ownership. The post reads that SoFi hits a 25-month high in institutional ownership after a modest conservative Q1 quarter of growth and profitability. We see additions here from 9 of the top 10 institutions, with one notable exception of 2 Sigma Capital, who liquidated out their entire position. They were previously the 7th largest holder of the stock, holding over 14.6 million shares as of the past quarter. Now, of course, you'll immediately ignore the 9 firms that are adding consistently, and you'll want to hyperfixate on the one firm that sold out and understanding why. Well, we don't really know why they sold out. There could be a number of different reasons. They could have made money on SoFi and decided to book those gains. They could have seen a better opportunity for their money in the market. They could have a conflict of interest with one of their private companies. Or maybe they're just tired of seeing the stock at $7 every day. Who knows, right? Everybody has different reasons for selling. At the end of the day, ultimately, who cares? It doesn't really matter because the 14 million shares that they dumped into the market were scooped up immediately by other institutions, by other retail investors. I mean, basically ARK Invest over that same quarter added that same number of shares and even more, as well as other firms who were willing to take those shares off of their hands because they were ultimately bullish on the Q1 earnings and the prospects that the company has going forward. So ultimately, is it bad that 2 Sigma sold out? No, because everybody has their own reasons for selling. It doesn't really matter, nor does the entirety of the institutional holdings really carry a deep significance with it. It's interesting to know, and we want to take a more detailed approach in terms of understanding which institutions are buying or taking an interest in SoFi. Still, though, I think keep in mind that SoFi is still a very small company in the grand scheme of things, and many institutions are either very restricted from investing in the company or it simply is not on their radar yet. Once the company is over $10 billion sustainably, or maybe over $15 billion sustainably, and profitable for 4 quarters, so it hits the year-over-year charts, then I think more institutions will take notice. Of course, as the company grows, as they keep executing, more institutions are going to take notice as well. So it's good to see this number growing, but I don't think we should be nitpicking on any single institution that buys or that sells. So the updated institutional holdings was one of the major pieces of news this week that came out. The second major piece of news came out on Friday when the Federal Reserve Large Commercial Banks report for Q1 was released. Now, previously we've talked about SoFi's ascent through this list, and per the report this week, SoFi is now number 74 on the list, showing over $25.6 billion in consolidated assets. Over the past quarter, they moved up just one single slot on the list from 75 to 74, and the quarter prior to that, they moved up 5 slots on the list. As we go further back, we can see a gradual decline in the pace of their ascension in that list. For example, here's a chart that Tanner made to lay it out all visually. We climbed the rankings from the 400s, we cut that down in half very quickly, and we cut that down in half again pretty quickly, and then gradually stair-stepping our way upwards to the point now where we've had the slowest growth quarter over quarter, just one position. I don't think that this will always be the case, that we're always going to climb one position every 3 months. I would be fairly shocked, however, to see them grow double digits again, because the remainder of the names on this list are just gigantic companies from a consolidated asset count. So it gets that much more difficult for us to climb and stair step and leapfrog other companies. So it's probably going to be, 2 positions here, 5 positions there, 4 positions there, 3 positions here, 1 position here. Maybe we go backwards a position on any given quarter. So we'll see how it goes, but I don't think we're going to see the double digits again. I don't think we're going to climb, 15 positions in one single quarter again. It's just unrealistic to think about because the numbers just get much larger here as we climb this list. And the last piece of news, which I want to talk about, the third major piece of news, is a follow-up from my last video where I talked about the Qatar Investment Authority and the 11.2 million warrants they had. Now, if you remember, these warrants converted 1-to-1 for stock, and I think Data Driven Investing made a great post here explaining this, so let's go through that in more depth. If you haven't seen the previous video where I talk about the warrants and the Qatar investment fund, I'll link it in the end of this video. Definitely watch that first so you're caught up with what we're about to talk about. So the DDI post reads, when SoFi went public in 2021, Qatar Investment Authority had 11.29 million warrants. Each warrant can be exercised for one common share of SoFi stock at a price of $8.86 per share. However, it makes no sense to exercise the warrants for $8.86 when you can just buy the shares on the open market at $7.28, which is what the stock closed off on Friday. And you're saying, well, why does this matter? Well, because the final day to redeem these warrants was essentially tomorrow. And since the market is closed on Saturday and Sunday, these warrants have essentially expired worthless. They're like a call option, and the strike price is $8.86, and the stock is trading below that strike price. Therefore, the options expire worthless. It's the same concept with warrants. Chris continues in his post that if the Qatar Investment Authority decided they wanted to go ahead and regardless to exercise these warrants, they would have added extra float from the treasury. So SoFi would have to issue more shares to essentially have more dilution. But of course, the Qatar Investment Authority doesn't want to do this because they would be taking a loss for these extra shares. Why would you convert the warrants at a higher price when you can just let them expire and then buy the stock on the open market for a cheaper price? So essentially, by letting these warrants expire worthless, because the stock didn't hit $8.86, it's a little over 1% dilution that was avoided because these expired worthless. Now, there is also a downside here, is that if in fact we were at $8.86, there would have been some dilution, but there would have also been about $100 million that would have been required to redeem these shares. Basically, the Qatar Investment Authority would pay to exercise 11.2 million shares at $8.86. That money would all be extra capital for SoFi to deploy in terms of their normal operations. So there would be some dilution, but at the end of the day, the company could leverage that money. I think it helps the narrative with regards to the dilution perspective, especially because with the 2029 convertible notes that happened just a couple of months ago, the conversation really heavily focused around that dilution piece of things. Finally, to wrap up this video, as a reminder, SoFi's 2024 annual meeting of stockholders is coming up next Tuesday, May 21st at 7 a.m. Pacific time or 10 a.m. Eastern. This meeting is going to include a Q&A session on shareholder questions about the proposals presented that are up for voting. So we're going to keep our eyes open to see what changes come out of that. I don't think I'll be able to live stream this event, but I'll let you know if that does change and I am more flexible to do that. Anyway, I hope you enjoyed this video. I apologize for any of the quality issues you might have seen through this video that are not up to par with a normal studio setup. Please let me know in the comments if there's anything I missed or if you'd like me to cover something more in depth in a future video. If you enjoyed this, consider subscribing to the channel. Like I said, I do these videos weekly, and if you've not done so already, consider sharing this video out so more people can see it. Thanks for watching, and I'll see you a little bit later tonight for the SoFi weekly podcast. I think it might just be me and Tanner tonight.